Markets are really focused on inflation. We just mentioned a little while ago that bond yields, they've increased 50 basis points since the start of the year. How do you think this impacts not only equities, but inflation in general?
Well, you start with equities. I mean, if bond yields continue to rise, if they, were to shoot significantly higher, then higher yields in bonds mean people probably rotate out of stocks, and that could definitely hit the stock market. I mean, in terms of the economy, the question is why are yields going up here? If it's because people are getting more excited about stronger growth in the end of the year, that's not a bad thing. I mean, if you think back into, quote, normal times, say back before the financial crisis, 10-year Treasury was generally around 5% or so, and that didn't slow down the economy all that much. So if it's a real scare just about inflation and people are building in risk premium, then that's a bad thing. But if it's really more about expectations of stronger growth going forward, then that's generally not that bad of a deal.
Jay, speaking of expectations, what are you expecting from the jobs numbers out later today? And if those numbers, they beat estimates, what do you think that means for price inflation and the markets?
Right. So the initial jobless claims, they're running just a little bit under 800,000 per week right now. It's probably going to stay somewhere around that. I think the more important number is the employment report tomorrow, and we're expecting 210,000 jobs were created in the month of February. Now, in normal times, that's a pretty good number. Given where we are right now, you would expect and hope to see some higher sorts of numbers. I think the key here is if it comes in a lot stronger than expectations, and particularly if the unemployment rate were to come down and the measure of average hourly earnings, if that ticks up, then people may get a little bit concerned about some higher inflation. If it comes in lower than that, then you could potentially see bonds rally on the back of that. And I would think that's probably pretty good for the stock market.
So you're saying if the number comes in lower and bonds rally, that's actually good for the markets?
I would think so, right? Because I think what's happening right now is with yields, what we've seen over the last few weeks or so is as yields continue to rise, when they shoot higher, that gets the stock market a little bit unhinged. And so if you get a sign of so the economy continues to grow, but not so fast that it's going to kick off inflation, that's kind of almost a Goldilocks sort of scenario. Good growth but low inflation, and that should be good for stocks.
All right, speaking of things that aren't too high, aren't too low potentially, let's talk about your GDP forecast. Your forecast for this year and next year is 6.2% and 5.1% respectively. How much is that directly tied to the vaccine rollout not only being successful, but people then going out and spending money in Q2?
Yeah, so Frank, I mean, it's very much tied to that as well. If the vaccine rollout continues to go successfully here, more and more people become vaccinated and feel comfortable about going out, then we think there's just a pent-up demand for lots of spending on restaurants and travel and movie theaters and things of that nature, plus all the money that people have received through these fiscal relief sorts of programs. Those two combinations, pent-up demand and a lot of firepower, should be good for spending. However, if the vaccine rollout were to trip up here, or if some big variant were to come along that made vaccines not successful against that, then that potentially could cause us to revamp back our forecast. So it really depends on how things progress here with the vaccine rollout and as well as the virus.
Shepard Smith here. Thanks for watching CNBC on YouTube.